At this point, we'd like to call up our panel members for tonight's meeting on an insurance checkup for boards of co-ops and condos. Our keynote speaker is Jason Schiciano. Jason is a principal of Levitt-Fuirst Associates, which, as you all know, is the insurance manager for the Co-op and Condo Council and the Building and Realty Institute. Joining Jason are, David Amster, chairman of our advisory council, of managing agents, and our two vice chairs, John Bonita and Jeff Stillman. Thank you, Albert. Jason will start us off, introduce the program, and then our panel will join Jason. Again, many, many thanks for your participation. I will now turn it over to Jason.
Just go on the order of this.
Yeah. Thank you. Good evening. My name is Jason Schiciano. I'm president of Levitt-Fuirst Associates. We're the insurance managers to the Building and Realty Institute. And this evening we've got an interesting. Everybody loves insurance, right? So I mean, this is the highlight of the agenda for the Condominium and Co-op Advisory Council every year is the insurance program. So thank you for attending. I want to first of all thank my fellow panel members, David Amster from Prime Locations, Jeff Stillman from Stillman Management, and John Bonita from Garthchester. And I also want to thank my colleagues from Levitt-Fuirst who are here, my partner Ken First, Pat Clare, David Frederick, Gerald Fredericks, Jennifer Apicella, Bonita Teets, and Robin Cohn. Many of you work with these people every day, and I appreciate them being here to support us. So I want to start out by answering the most important question related to this program this evening. It's already been asked several times to me this evening, which is, what is this?
Thank you.
It's obvious, isn't it? You know, when you get a tchotchke, a handout, the first rule of handouts is you should know what it is without having to read instructions. So I failed miserably in this regard. And I must say I'm on a bad streak because the hand sanitizer that I did before this, people were mistaking for mouthwash. Breath freshener, that didn't go over well either. So at any rate, maybe I'll get lucky the third time around. But what this is, you peel it off.
Got a rash.
All right.
Those things are great.
And you put it on your cell phone back, right, like that. You can put a business card in there or a credit card. You don't have to take your wallet out, and then it even stands up like that for a little TV. Okay. Now we got that out of the way. All right.
Very creative.
I wanted to have, one of my colleagues do that demonstration. They all refused. Nobody wanted to take responsibility for this handout. So I had that coming to me.
Everybody's grabbing them now.
Yeah, now that they know what they are. Okay, so what? Now that we got that out of the way, what's the second most important question that everybody wants to know about insurance? What? I heard it over there. What's going on with premiums, right? And it's been a rough few years for condos and co-ops with respect to insurance premiums. Premiums, if your loss history has been, and everybody knows what loss history is, for those of you that don't, if you take the losses that the insurance company has paid out in claims, legal expenses, other fees to do investigation work, or reserve and expects to pay on a claim for those types of expenses. Those are the incurred claim costs divided by your premium that you paid over a period of time, like 5 years. That's your loss ratio. So over the last few years, even if your loss ratio has been really outstanding, maybe under 20%, under 10%, even then your premiums have still gone up maybe on average 5% a year, 6-7% a year. If you got lucky, you were a little bit less than 5% a year over the last few years. But it's been tough. If your loss ratio has been poor, well above 30%, 40%, 50%, or you had a real bad loss, like multiple buildings, if you have like a garden-style condo or co-op, and you had a big ice damming event where 6 or 8 buildings were affected and multiple units, or you had a fire or something like that, or a big slip and fall liability claim, where they reserved $250,000 to settle the thing, something like that, your premium may have gone up 50%, 100%, or more. And I've seen it, and I've had to explain it, and it's not easy to explain. So the good news is, and to get all of the most important information out front so you can put your mind at ease and enjoy your dessert, is that I think we are starting to see and have seen for the last several months a departure from that trend. I don't know, and everybody knows that the insurance industry, like anything else, is a financial market. So it goes up and down. Not sure what's going on with how the stock market is going to affect this. But for right now, insurance premiums are pretty stable and steady. You can see on the chart that I put in the handout that you can expect to pay overall an increase if your loss history is good over the last several years, 5% or less on your insurance renewals. 5% or less. Typical on insurance renewals over the last couple months, and no reason to expect to think that is going to change in the future. Some of your insurance policies are going to be going up less and others more. Your directors and officers, I'll mention, is an issue. There are very, very few carriers that write directors and officers insurance, and it's obviously a critical, not optional coverage. And if you have any claim activity whatsoever, even if it didn't happen last year, your premium is going to go up, and it may go up a lot. Your premium could easily go up without any claims 5 to 10%, and if you have claims, premium could go up 20% or a lot more. You might have to, replace the carrier and go to a carrier that doesn't typically write condo co-op and D&O insurance, and you could be faced with. So, point being is this: there's a lot of programs on the CCAC agenda dealing with house rules and pets and how to deal with bad neighbors and all those things. Just be mindful that when you take a position as a board on something that could invite a lawsuit against the board, which is, I'm not saying, you got to stand your ground, right? You got to make choices in life and in business, and you're right. Just be mindful that your D&O insurance, if there's an action started against the board, is going to be affected, and it's going to affect your premium potentially for several years to come. Okay? So that's that. That's the premiums. Does anyone have questions on premiums? Okay. The next thing I thought you might be interested in is, since what's coming this weekend? All the skiers out there.
Snow. Jason's out.
Maybe.
All the property managers are like, oh, snow.
Jason's
Right. It's been a pretty mild winter, incredibly mild winter. Great for condos, co-ops. Great for the managing agents that have to care for the property. Great for insurance companies. Not so good for skiers. But maybe this weekend that might change. So, keep in mind, snow removal contractors, it's critical to be named as an additional insured on their insurance policies, to make sure that that's actually the case, to verify that, to look over the indemnification agreement within the contract, and you should have a contract with your snow removal company to make sure in particular that it's not what's called a reverse indemnification agreement, where you as a condo or co-op are actually indemnifying or holding the snow removal contractor harmless for accidents, bodily injury, property damage that occurs from his work at your property. That's actually happening now. You've got to be mindful of that. Some people not reading those agreements sign it, and it should be the exact opposite. So you don't want to put yourself in that kind of liability scenario and have your premiums affected if there's a claim. Shut off your faucets, obviously. You have wood fireplaces. Chimneys can be a big problem. You should have some sort of a method for getting those cleaned by an insured qualified contractor. Portable heaters, every year we get a claim or two on portable heaters starting a fire. There's nothing you can do. I understand that boards and managing agents can't dictate that you're not allowed to use portable heaters, and there's no way to police it anyway. But people hopefully have some value, on their own life and the lives of their family and the people that are living around them. Tell them, remind them that old heaters are dangerous. that they should go out and buy a new portable heater that's got safety features, etc. And the life they save might be their own. This is another big one: thermostats. Many unit owners, shareholders, when they leave, they go to Florida or wherever for the winter. They go away for a week or two, and if they're, especially in a townhome type community or a community that has each unit has their own thermostat, they shut the thermostat way down, and of course we get freezing cold weather, and the next thing you know, there's a pipe burst or a pipe freeze, and there's tremendous damage not only to the unit but also to the common areas. So again, a notice in the mail, when you send your billing statement, an email, posting if you have common areas that people look at, noting all of these winter preparation reminders now that winter apparently is actually upon us, it can't hurt. It might help tremendously, and it might end up helping you with your insurance premiums. The last thing I want to comment on winter things is ice damming. We've covered ice damming before. Everybody knows that's where you get snow on the roof, and then it melts and freezes and backs up into the gutters. Tremendous damage to units, etc. There's this horrible thing called a per unit ice damming deductible that some carriers put on policies, especially after you have ice damming claims. Don't give them an excuse to do that. If you get an accumulation of snow on your roofs, think about ways to get that snow off. Hire a qualified, insured contractor, get the indemnification and everything, get the snow off, possibly install heating elements to melt the snow. Those ice damming claims wreak havoc on your insurance premiums for years to come if you have a major claim. The next thing I put on my list was fuses. If you're an older building that has not converted to circuit breakers, don't wait any longer. It's a tremendous expense. It's hard to do. How do you get into shareholders and get into their unit and force them to change it? I know it's a pain, but if you still have fuses, you're going to have an increasingly difficult time of not only getting competitively priced insurance, but insurance altogether. It's that big of a deal. Okay, insurance carriers are assuming by now that you will have transferred over to circuit breakers. And if you haven't, you're going to be in a whole different world of insurance premiums, if you're not already, very soon. So keep that in mind. A couple final things. Cyber liability, what is it? Everyone's heard about data breaches. They've been in the news all over. The finest and best and wealthiest companies in the world have been hit by cyber data breaches. So you shouldn't assume for any reason that you're somehow immune to a data breach. Either of emails floating back and forth between board members of a co-op regarding the finances and social security number and address of a potential co-op purchaser, or anything along those lines, bank accounts, etc. So cyber liability is a relatively new threat, and there is insurance that can be purchased to mitigate that exposure. It's relatively inexpensive. A condo or co-op can buy a policy for under $1,000, and it's something to think about. And finally, Jeff and Albert mentioned Labor Law 240, the scaffold law. It does affect contractors. It also affects your buildings, since as property owners, you are liable for any gravity-related injury to a contractor working at your building. Even though you're not supervising them, even though you're not providing a ladder, even if they were drunk, etc. So that's a horrible law that makes you absolutely liable. There's no comparative negligence in New York like in other states. We've been fighting it forever. We're going to be fighting it again in February, the BRI, and we'll be up in Albany trying to make a case to the legislature. The only change this year is that Sheldon Silver, the head of the New York State Assembly, is not there anymore. He's not calling the shots. You won't be able to block legislation, but legislation has to be brought, obviously, to the floor. So we'll be trying to make that happen. Hopefully we'll be successful. If there's any type of reform or repeal whatsoever, it could end up benefiting all of us. So any questions on the topics that I hit on? Because the next three speakers are much more entertaining and interesting. So, yes.
Are you smoking?
Yes.
The cyber liability, is that more of a function of the management company than the co-op itself?
Well, it's a good question, and it depends. It's an exposure that can face either the management company or the condo or co-op. Certainly, there's probably, based on what I understand to be information flows, more of an exposure for a co-op than for a condo, with respect to, in particular, emails with financial information and social security number being shared amongst board members of a co-op. The managing agents have exposure as well, and I know several of them are looking at this insurance as well. So it is it's a sort of a new frontier, and everybody, both the managing agent side and the condo or co-op side, have some exposure. Anything else? Yes.
Is there any change in New York State law that would require that co-op unit owners have an HO6 homeowners insurance policy, or is it?
There's been no change in the law that would would require that. No.
So it's not mandatory, but it's advised.
It's strongly advised. And the best thing, and I think David is going to speak to this, so I don't want to steal this. All I'll say is that, from the insurance perspective, is a shareholder or unit owner, if you don't have an HO6 policy and someone slips and falls and hurts themselves in your unit, there's no protection. But even bigger than that, and this is what really gets to you, is I've been for somebody in this room, a building that was managed. I've been at a building that burned down, right before the holidays. And a number of shareholders were put out, in essence, into the street. If you have an HO6 policy with loss of use coverage, your alternate residence, your hotel room or your apartment building for the next 6 months or a year or whatever it is, while your unit's getting rebuilt, is covered by insurance. If you don't have that, you better hope you have a relative that really likes you. So, sometimes you got to scare people into doing the right thing. Anything else? Okay. So, next on the agenda is David Amster from Prime Locations, who is the president of ACMA, the chairman of ACMA, and he's going to be speaking on communication with boards and residents regarding insurance matters. Thank you.
Well, thank you. I think it's really important for managing agents to educate boards, and a lot of times boards really don't understand insurance. They understand insurance by seeing some little gecko on TV every night. They understand there are 1,000 insurance companies out there competing for my business, and quite frankly that's not the case. We live in a very limited insurance area. There aren't that many insurance companies that actually can supply and insure your buildings, especially in this area. So when you go out and, we bid out insurance every year with Jason's company and a number of others, you have to understand it's not that simple. If you have an insurance agent and a managing agent you're very happy with and have done the right thing by you every year, it's not necessarily like you can go out and bid your insurance out to everybody else, because there's probably 5 or 6 different companies that would write a policy in Westchester County for buildings like yours, Coops and Condos. And the problem is there's probably 1,000 different insurance agents out there who are all offering the same thing, but quite honestly, these policies are pretty limited to who you can go to. And once one agent bids with a company, the next agent coming in is kind of blocked out. So, I try to give my boards information and teach them that, it's not like you can call up Allstate or Geico and get a quote the next day. It just doesn't happen that way. The other thing is, you should be familiar with the coverages you need. I think Jason went over those things. I mean, standard coverages for any co-op or condo is property coverage, general liability coverage, umbrella coverage, directors and officers coverage, crime coverage, pollution coverage, flood coverage backup, and then there's this little thing out on the outside which is not necessarily included in your policies to an adequate extent, earthquake coverage. We live in New York, what do you need earthquake coverage for? I remember sitting in my office about 2 years ago, and my building was shaking, and I'm saying, I think we went to a meeting actually with Jason a month later or so, and I'm at a large client of ours. They're saying, what do we need earthquake coverage for? I'm saying, well, I'm not the one going to tell you not to take it, but you really have to take the advice of your insurance broker. You really have to have a lot of confidence in the people you deal with to understand what kind of coverages that you need. The other thing is the cheapest is not necessarily the best. A lot of times you get boards who look at a thing and say, well, we can switch to this company, or we can switch to this company, and that's not necessarily the case. Look, this is $5,000 less than we're paying on our $80,000 premium. And, okay, you advise them not to. They go ahead and they say, well, let's go with that. You move to a different company, and they say, you know, a month later, 2 months later, oh, by the way, you should sprinkle your building, or we have some insurance recommendations that have to be dealt with. So you have to be very careful of the marketplace and where you go. Switching companies for small savings is sometimes not wise. Sometimes you stay with your company that you've had, they have a history with you, you're probably in a better position. One of the things to educate boards is I always say it's a good idea to invite the broker who's the expert. We're managing agents, we deal with insurance all day, but I'm not an insurance broker. I usually like to invite the broker to a board meeting, usually right before renewal, and let them explain to the boards what their coverages are, where they may be lacking, understand the policies that you have, what's covered, what's not covered, what do you really need? And, quite honestly, your broker is the one who can best advise you based on your history, your loss history, and other factors that are involved. Something that comes up more and more nowadays with boards is the crime and fidelity coverage. That basically covers you from theft for money stolen by the managing agents, board members, employees, etc. And boards sometimes underinsure, and then there's an issue now that's coming up more and more with Fannie Mae guidelines. And when people are buying apartments and they're looking for insurance, Fannie Mae comes in and they have certain guidelines that they want to see if they're going to issue mortgages. And a lot of times we get calls from a mortgage broker who's representing a purchaser in a building, and they say, well, you know what, the insurance on the fidelity coverage is not adequate for our guidelines. Usually I think it's a 3 months of income is the minimum requirement. You may have some boards that say, why do I need that much coverage? It's really not that expensive to increase it, but you should certainly cover the amount of money you have in your bank accounts. Obviously, there are some buildings where they don't have a lot of money in bank accounts. Fortunately, this year we're getting away with a lot with fuel prices and things being down. But you really have to have the proper coverages so that you can make sure your shareholders don't have problems getting mortgages if they're selling their apartments. And last but not least, it's shareholder protection. Why do shareholders need to have insurance on their apartments? The building's insured. If the building burns down, they're going to rebuild it, right? Well, I can tell you about in 2000, I think it was 2003, we had a 106-unit building that basically, I got a call on a Sunday morning. I was actually out in New Jersey with my wife shopping, I think it was at IKEA, I remember this distinctly. My manager called me and goes, I think we have a problem. There's a fire at one of the buildings. Not unusual for a managing agent to get a call like that. Other than I said, okay, I'll be coming over there, figuring by the time I got there, you know what, it'll be out, we'll have a little claim, we have an apartment or two that's damaged, what's going to happen? Well, I get there probably about, a half hour later, 45 minutes later. The entire building is engulfed. It started, believe it or not, in apartment 1A, right in the center of the lobby. It was an old building built in 1926. Went up through hidden cock lofts and through, they used to have the dumbwaiters that were sealed in apartments. Went up to the roof, went over. By the time it was done, 13 hours later, with about 5 or 6 tower ladders pouring water into the building, the top floor had collapsed into the 5th floor. The entire building was a total loss. I can't tell you the feelings I had when probably at that point in time, I'd say probably 70% of the people who owned in that building did not have insurance on their apartments. And for $200 or $300 a year to insure those apartments, these people the building took 3 years to rebuild. So they had to find alternate housing. Obviously, they didn't pay for their maintenance charges during the time they were out. But an enormous amount of people just didn't have insurance. And I bring that up to every board meeting, every annual meeting I go to, I tell that story. Where, you know what, this is something that, you spend $200 or $300 for insurance, you should have it. Most co-ops and condos can't mandate it because your proprietary leases do not have that requirement. But we try to make sure that, people understand when they're purchasing, it's very important that you get insurance.
They're important, sometimes something to think about, but not necessary or required. Insurance is placed with a new carrier. Recommendations will follow an initial inspection if not taken care of. The insurance carrier has the option to cancel. The insurance is renewed with the existing carrier. There will be an inspection with possible recommendations. In this case, there's generally more flexibility and room for discussion. Jason said that's where the broker can be particularly helpful, and how these recommendations are to be addressed. Hopefully the board and the management company have established a good and long relationship with the company. Jason said you don't want to keep switching around, and your claims and lawsuits are hopefully low and not severe, and you have addressed recommendations in the past, and to maintain the buildings to the insurance company's standards of satisfaction. If the recommendations could become too costly to address, the insurance broker and management can intervene and assist in finding other alternatives. You always need to address the risk-benefit of these recommendations. Insurance companies are looking for a reasonable effort from boards and management to provide a safe and secure investment. The recommendations provide actions to assist in risk management, which is the key, in understanding what is risk management exposure. So I want to define risk management a little bit. Risk management is the effort to deal with many uncertainties that exist at a property by understanding their nature and the likelihood of occurrence. You want to control or reduce these risks to acceptable levels. These risks generally fall into 4 categories: safety, security, emergencies, and liabilities. Liability. Approaches to managing risk fall under avoidance. You like to eliminate it altogether. Retention. There are some things you just can't do anything about. There's control to reduce the risk and transfer of the risk. Properties look to transfer risk onto insurance companies. Insurance companies look to reduce the risk by making these recommendations. Premiums are also affected by risk, so the more compliant you are with these recommendations, the better opportunity you have to lower your premiums. Jason was touching on. In a period of rising rates, as Jason talked about before, not necessarily in tremendous rising rates, but there have been years where they've been pretty severe. The markets will tighten, and there's competition and limits to your choices. So also by following these recommendations, you can avoid accidents and claims which would be costly and quite time-consuming to resolve. The second area I want to talk about was some examples of common insurance recommendations. So we fall under a few categories. One would be building and what we call SAE exposure and recommendations. So you'll have some fire hazard exposure, for example, a barbecue grill kept at a minimum distance in accordance with local building codes. Fire hazards, I was going to talk about this, but Jason covered it already. Circuit breakers and installing circuit breakers and removing fuses. Water damage, for example, you have to repair loose shingles and flashing at a particular location. Another water damage exposure is making sure you repair brick pointing where loose mortar exists at particular locations. Flooding, repairing sewer catch basins or replacing them. Another property damage exposure is trees hitting buildings or close to them. You maintain those cut off branches and overgrown trees or removing trees. And you can get into examples of general liability exposure and recommendations. Tripping and fall, to replace cracks or unevenness in the sidewalks, repair the cracks. Bodily injury, repair loose handrails, for example, and store mounted brackets and air exterior air conditioner. And then there's contractor liability, general liability, third-party injury, which could also be causing property damage. You need certificates of insurance, identifying you as an additional insured, and identifications, Jason touched on that before. And there are always, most people focus on a lot is life safety recommendations. You can have exposure to liability, dealing with emergency lights, smoke detectors, CO2 detectors, making sure your entrances are locked, making sure there are panic bars on the roof, and if you have alarms that are properly working. Alarm maintenance, a lot of places have gyms. You have to make sure the equipment's working properly, there's exposure there. And those are just a few of the examples of recommendations you have to be careful of. The third category I wanted to talk to is about how to prioritize and budget for insurance recommendations. And there, I think you should try to establish a criteria. Start with what exposure that was identified by those recommendations will have the greatest adverse impact on the property. Assigning a monetary impact is a good place to start, but that's not always easy to do. You need to identify the risk, assess the likelihood of its occurring, along with the potential consequences. Some risks are prevalent in most associations, such as building issues and security and life safety, but other risks can be unique to your particular property. Jason mentioned before, cyber liability, cyber attacks. Someone asked that question earlier. There are some properties that have their own site offices, and if there's their own equipment, sometimes that equipment could be the management companies, sometimes that software and equipment could belong to the property, so there you might have some exposure. Another risk that can be unique to your property, for example, is like environmental, like potential for natural disasters. So if you live near a stream or a river, you have more exposure than a place, the property whose building isn't near there. So you have to look at what's unique to you as well. You should obtain proposals from contractors, examine your current operating and capital budgets, and based on that priority criteria I mentioned, include them. See what work can be done by the building staff versus outside contractors as well. It's the ones that save you money. When making the budget, sometimes an item might require replacement or major repair, but you might have enough funds in the budget. In that case, you might have what's called deferred maintenance. You can make the temporary repair, which will carry you over until you have the funds. Insurance companies sometimes will accept that approach. You also sometimes get into timing issues, the time of the year when they might want you to make that repair. So you have to work with them, they'll give you time. And they want to see a plan, they want to see something outlined, they want to see adherence to it. When you're doing your budgets, review prior requirements and set up a plan to address them. So it's always a good time to pull out those recommendations for prior years and look at what's going on, and maybe even do a pre-inspection when you're doing your budgets, operating as well as capital, so you have that money available. And again, deciding where those funds are going to come from operating budget, or they're going to come from a capital improvement program. You have to look at your reserves, you have to decide, you have to do assessments. These are all issues that come up. The last item, quickly, I wanted to talk about was how to avoid recommendations by having a solid capital improvement and annual maintenance repayment plan. Maintenance repair plan. Touched on that a little bit earlier, but the idea is basically to be proactive to prepare for the potential losses. Management company should be conducting routine building-wide inspections, quarterly, annually, semi-annually, have checklists and a follow-up protocol. Do it early enough so you have enough time to correct the issues before the renewals. A lot of good programs out there for inspections, technology, tablets with software built in now, it's easy to do. Take pictures, it's always helpful. And then try to establish a preventive maintenance program, which is, the inspections are generally part of that. Identify all the areas in the building, set up work order Excel sheets or particular programs with action lists, and make sure these items get taken care of. basically these programs, these maintenance programs, can fall into like 4 categories. One I would call deferred maintenance, which we touched on before. Another is preventive maintenance, you're just trying to be ahead of the curve. I always like to call this area custodial maintenance, and the staff's very important. When your staff's working there every day, they should be trained and exposed to what these risks are on the property, and they're, when they're working around the property, there's no reason they can't report back to the manager or the superintendent. Items they might have seen, but they do need that training to show ahead of time what to look for. And that could be a big help in lowering the risks with insurance. So anyway, that was the areas I wanted to talk about. I hope I've been able to provide everyone with some reasons why the recommendations are important and should not be ignored. So some ways of handling the recommendations and how to be proactive. Thank you very much.
Yes, just a quick question. You did mention something about co-ops that have gyms and the liability there, and we don't have a gym. But we have the request from a shareholder to maybe modify an existing bike route into an area where that can be secured and maybe the seniors can have a place to meet during the day. Does that bring up extra liability issues?
Well, from my experience, insurance companies do insure gyms on properties as long as the proper protections are in place. I mean, Jason may want to talk about it a little bit more, but yeah, from my experience, I've seen properties have unit owners sign waivers, so they're waiving their rights. And the main thing is have a plan to make sure if you're going to put equipment in there that is properly maintained, or provide a service contract with the companies and install the equipment. And get if you have the right program. Jason.
No, I mean, it's basically what Jeff said. Yes, you can put a gym in, workout facility. Yes, it increases your liability. Yes, the insurance company normally has no problem with it whatsoever. And yes, everything that you can do in the form of waivers, maintenance plans for the equipment, etc., to reduce or mitigate your liability is a good idea.
Well, our place wasn't a gym. It was just really modifying the room for another
Whatever it
meeting
is,
room.
right? All of those
So you
things.
still have to have waivers for someone?
You don't have to do it. No, you don't have to. It just reduces your liability. The insurance company will require it.
Well, if you're deciding to have a meeting room versus a gym, that's a different
Yeah, it's.
category.
Yeah, meeting.
It's a meeting.
Meeting room.
Unless you're going to start boxing in the room. Or something.
I'm happy. I'll talk to you about it, but you can do it. It's not a problem. All right, so, point being with Jeff went over a lot of small details on recommendations. It's unbelievable how detailed and important recommendations are and the monetary planning for it, and how those relate to insurance. So I appreciate the detail that Jeff went into on recommendations. Next and last is John Bonita from Garchester, who's going to discuss when you have a plan. If all else fails, if you did the recommendations or you didn't do the recommendations, you communicated with the board, as David was talking about, to make changes, or you told unit owners or shareholders, get your fireplace cleaned, or change the hoses on your washer and dryer. Something results and you have a claim. And John's going to talk about the different types of claims that you can have and the different responses as a managing agent and a board that you might have depending on the type of claim. John?
Good evening, everybody. I am going to touch on insurance claims. With this weekend, it sounds like we're going to have our first snow event. I know Jason's very happy as a skier, and all the property managers are not. And it's interesting because the number one thing for me that I've made note of, and you'll probably have, when you have snow, you're going to have a slip and fall claim. You're going to have somebody that slips and falls. And you may have a situation where somebody just slips and falls and it's kind of minor, oh, no problem. Put the insurance company on notice. You never know. They go home, their back starts hurting, whatever the case may be, you get a claim later on. Reporting a claim as soon as possible is the most important thing. The staff should be made aware of that too. Somebody comes in and claims that they have fallen down, but they're not hurt. Make sure the staff tells the managing agent and report the claim. Damage to the property. Any damage that warrants a claim, first of all, let the managing agent do their job. The board should not get involved. Sometimes boards will get involved if it's a situation with a resident, whatever the case, report the claim. If the claim results, as I believe David mentions, and it's a sad thing, even to this day, I cannot understand why every renter and every shareholder does not have insurance, but you will be amazed how many do not. Unfortunately, if the claim results in loss of damage to personal property, that resident has a real problem. The other thing I think also David mentioned about if you have the old tub overflow, and by accident it happens, people get a phone call from their child out in California talking away and tub fills, it overflows, causes damage to the building and causes a lot of damage to the personal property below. Any damage to the personal property is between the residents. Your co-ops and condos do not insure personal property. Your master policy will not cover that. It's a sad, sad thing. So the more you can encourage people to be properly insured, the better off you will be. The last thing, actually, my report's going to be very brief because they've covered a number of things. When you have a minimal claim, a small claim, know what your deductible is. The deductible is $5,000, for example, and the claim is $5,800. Don't put in a claim. It's a nuisance claim. The more claims you put in, the more difficult it can be on your loss records. Obviously, if it's substantially more, then you would submit your claim. Avoiding claims, as Jason mentioned, thermostats, people go away, townhouses, and they lower the thermostat too much. And many of these townhouses are poorly insulated. This happens all the time, and you have freeze-ups. It's an expensive damage. In mid-rise, high-rise buildings, there's roof drains. Nobody goes up on the roof. Remind your superintendents, make sure the drains are cleared. Many, many leaks occur because of drains that are blocked. And again, back to townhouses, cleaning gutters, it's amazing to me. That is a source of more leaks, especially in basements. And will contribute to your ice damming problems. So the important thing is doing preventive type programs such as that. Anybody has any questions? I'm happy to address. Yes.
I've heard the term H06
Right.
as a type of homeowners insurance. Is there an H05 and H07? Can you just basically say what is an H06 cover?
Well, the H06 policy is your personal homeowner's policy, and will cover you. You'll have a liability and cover for your personal items. There's variations of it, depending on how much your personal items are.
And it covers, it also covers any damage to a neighbor below or...
Yes, if you've caused a leak, such as overflowing a tub, and their property is damaged below, it'll help you with an insurance claim.
Right. The policy that a condo or co-op owner would get is going to have property coverage, and you need to discuss this with your broker to cover the improvements and betterments, additions and alterations to your unit, as well as your contents, and will also cover, as we discussed, loss of use if you're forced to leave the apartment due to a covered cause of loss. And then, to your point, it covers liability if you have liability to a third party, which could be a shareholder or unit owner below you, for bodily injury, or in the case you're describing, property damage. That's the liability side, the personal liability coverage that comes with the policy.
And one thing, again, that all the speakers mentioned, the importance of having a broker that's familiar with condominiums, and especially co-ops, that understands the proprietary lease and what's covered and what's not. Again, I've had many people over the years that I've been in the management business who are insuring the property. You have to insure the property. The master policy will insure the property. You have to insure your personal property, your liability. That's what's most important. So don't over-insure. And when you speak to your broker, ask them if they're familiar, especially if you live in a co-op. It's a different thing. It's important that they understand what is covered and what is not. Any other questions? Yes, ma'am.
I feel sometimes like we're in a catch-22. We have an occupancy agreement, a proprietary lease, and it says exactly what the co-op covers, what it doesn't. So if the toilet doesn't overflow or the bathroom doesn't overflow, that's easy. That was my fault. I did it. But a pipe behind the toilet leaks, goes downstairs and ruins everything downstairs. Now, according to the way I understand it, because that's behind the walls and it's the co-op, it's not the shareholders' insurance that would need to be tapped into. Yet what you're saying is don't submit that small claim. So we end up spending thousands of dollars a year, the co-op paying for just exactly those things where a trap got clogged or behind the wall leaked. So we have thousands of dollars of those kind of claims that maybe are too small to put towards our insurance company, and yet they're not covered by the shareholders. So it seems like our insurance really only covers the devastating.
I think if I heard what you said in there, you may be paying for claims where a pipe behind the wall in the common area of the building breaks.
No, in someone's apartment.
Okay, a pipe behind the wall in someone's apartment breaks and causes damage to an apartment below, including the contents and the cabinetry and wall hanging, etc. And if you're paying the unit owner or shareholder for all of their personal stuff that got damaged, rugs and carpets and everything, and wall hangings and repainting, you may want to discuss that with your insurance broker and your attorney, because it's probably not your responsibility if the shareholder or unit owner wants to sue the co-op for liability due to negligence. Then possibly your liability policy will pay for that, but you shouldn't necessarily just start paying out cash to the unit owner to
No, but I don't think that's what
Did I miss your point?
I think.
No, that's pretty much it. But to your point also, to have a maintenance program, to take 100 units and to go through and say, we know our history shows that the pipes behind the toilet are breaking like crazy and it's costing us thousands of dollars. Is it reasonable to other co-ops do that, start a maintenance program to go year after year, take a handful of apartments and replace bad piping and bad tub things so that they don't get all this?
Go ahead.
Well, I was sort of touching on that a little bit.
Just a little louder, please.
I was sort of touching on that a little bit when I talked. The answer is, if that's your history, and that's happening frequently, that is probably a good idea for you to start looking at it not from an operating perspective, but from a capital budget and reserve fund perspective. You start figuring out a plan, probably over some period of time, how you're building the structure, how it's set up, to start a replacement program if that's what's happening. The building's old, typically that's what happens in older types of buildings with plumbing. Plumbing's very funny. You can have some years with no plumbing leaks, and you can have other years come at you once. And one of the years we always, our office try to have discussions on what that's all about, and I've talked to many plumbers about it, and it seems to take a life of its own in some respect. But you're really having issues with that, and say especially if it's an older building, you probably need to start figuring out over the long haul how you're going to replace those pipes.
I would just put a little bit more emphasis on that. I mean, he's absolutely right. If what you said, you probably didn't realize how important it was that you said it. Your loss history, your written insurance company loss history is like your driving record or your credit report. And if it shows that you've had 3 or 4 or 5 flushometer breaks over the last few years, any insurance company looking at your insurance loss history can look at that and say, I'm not touching this building with a 10-foot pole.
And Jason, that's the point, we don't claim it, so if there is no history from the insurance.
That's fine. If you don't claim it, that's great. You're probably
That's what
doing the
I'm
right
saying.
thing. You better start fixing them, because at one point you're going to have a claim that you can't pay out of pocket. You're going to have to go to the insurance company. They're going to pay the claim, and then they're going to non-renew you because they just paid $250,000 or whatever, and they lost their shirt. And you're going to look for a new insurance company, and they're going to look at your loss history. They'll see that. They're only going to see one claim in that case, but any type of multiple reporting of the same claim could be a big problem. You're in a catch-22 right now, like you said. You got to get out of it.
I mean, forget the insurance issue. If you're having all those leaks, quality of life for the residents, I would think would be a little uncomfortable. So I would probably focus more on that, what you can do to fix that.
Yeah, and we're only talking about, right now, we're talking about damage to the building, not personal property.
Right.
So we understand.
Yeah, mostly it's the ceiling, and then the paint is custom, so we have to be.
Another question?
Yeah, you see, you touched on my question. It's my understanding if the pipe inside the wall breaks and it drips downstairs, that the co-op would replace the wall board. But if the unit owner had $10,000 a square foot wallpaper, that's their problem. not
That's
my
their
problem.
problem. That's their problem.
And if they have special paint on their finish, you're supposed to put the prime, and if they got $10,000 paint that was destroyed, that's their problem.
I think it's also important to understand in the reporting issues with insurance companies. You don't want to build up, 100 reports a year for damage. But there's definitely a difference between a property claim and a liability claim. And my policy in my office is if somebody calls our office and says, I opened the front door and I got a hangnail, we're going to notify the insurance company of that particular incident. When somebody calls and says, well, we had a leak or something, we're going to assess it. Because as they said, as John and Jeff said, you have a $5,800 claim on a $5,000 deductible, you don't necessarily want to build up a loss history based on those small little claims. That will make your insurance bill much higher. But on liability claims, you've got to be very, very careful. Because, and I'll give you an incident that happened with one of our buildings, and board members should be very well aware of it. It's not only the management company who has to be aware of somebody slipped and fell, but the building staff has to make sure they're aware of it. So we had an incident a number of years ago with a property where a board member was walking with a friend in the garage. A friend slipped and fell, hurt her ankle. The board member never said anything to anybody. It was like a private thing. Probably 6 months later, we get a lawsuit that comes into the office, and they're suing for $5 million. Which every claim is $5 million. It's crazy. But we didn't know anything about it. We turned it into the insurance company, sent it over. The insurance company does their investigation. Turns out, well, the person who was injured said, well, I was walking with Miss X. She's the president of the board. She didn't tell anybody. There was the insurance company denied coverage in that particular claim. It wasn't a $5 million claim. It settled for, probably $10,000 or something like that. But understand that board members have a fiduciary responsibility in the building, and if you hear anything, you should notify your managing agent, so that they can put the proper notice into the insurance company. A lot of times the notice is nothing more than a notice, but at least you're protecting yourself.
And they'll put it on record, not necessarily it's a claim. Yeah. I wanted to bring up a comment on one item. There are situations sometimes that a lot of people discussing this personal property versus building property coverage. And there are times where, a lot of times an example is like the floor, where the basic floor is the responsibility of the co-op. Use that as an example. Someone now decides to change that floor. It's on some fancy special wood or tile, special tiles or marble in the bathroom. There's ultimately a claim And that, the floor of that basic structure would be the co-op's responsibility to take care of it. But that additional amount of money or that additional extra enhancement, betterment they put on would be the responsibility of the unit owner. So that does happen quite a bit to get into those discussions.
Just like the fancy wallpaper or anything else, there's betterments and improvements that you need to put on your policy.
So kind of into that, if a homeowner or someone has a an apartment, basic things in there, then they come in and do a whole redo. How do they cover that? Do they go back to their homeowner and provide pictures, they look at now got the stainless steel, the granite, everything, and raise their homeowner's insurance, so if a problem happens, they're covered?
Yes. In many cases, I mean, if you read the, probably mostly co-ops represented here, I would assume. Typically, co-op proprietary lease will say that the shareholder is responsible for any improvements, betterments, additions, alterations made by that shareholder or any previous shareholder since the beginning of the co-op. So if you bought a unit that's, in a building that's 60 years old, I will bet you, all the money in my pocket that virtually everything's been upgraded. The floors, the fixtures, the cabinets, the bathroom, everything. So all of that has to be insured by the shareholder's HO6 policy to whatever amount of money the shareholder thinks is the appropriate amount of money. And then when you have a fire and everything's destroyed, they'll go through and they'll dig out the little scraps and, there's a piece of, bronze faucet handle. And they'll know you had a bronze faucet handle and they'll give you a bronze faucet handle.
So as the co-op, they just go back to the original plan.
If that. If it's been altered in some cases, you won't get anything. You won't even get the original. It all depends on how the proprietary lease is written.
So they can have the responsibility.
In a condo, you get bare walls, typically. You get the drywall. It all depends on the language of the lease or the bylaws or the offer. And I've seen, if I read 100 documents, there might be 50 different languages. They're not all completely words. Do you agree, Pat?
Completely.
You see more than I do. Okay.
Okay, one more question.
What's the reality of doing a plan to cover the risk? Do we really have, is there some, asymptote that we reach a place where the premiums really stay low if we do all of the good stuff to make sure the building's in good order?
No.
You should repeat the question.
Yeah, basically, if I understand, if you do all the recommendations and all the things that the insurance company asks, does that help you keep your premiums low? And basically, no. It keeps you in the game. It keeps you in good stead with your existing carrier, probably helps you mitigate an insurance claim, a loss, which in turn keeps you in the game for all the other insurance companies that might be interested in your property. Whereas if you don't do them, your current carrier could drop you, and a new carrier is going to have the same recommendations. So,
Yeah. And that actually is the recommendation. They ask about processes and procedures or certain life safety programs. Come up every now and then. There's those type of, do you have them? It's usually something, yes or no, you move on, you can't come up.
It's definitely got more complicated. One last point, with insurance claims, recommendations. Insurance companies will work with you, but you got to respond. They will work with you and let you do. If you show that you're going to take progressive steps to satisfy their recommendations, they're very good that way. If you just don't respond, you're going to have a problem.
Please join me in thanking Jason, Dave, Jeff, and John for a great presentation.